Hi, this is Larry Schober, CIO of SFG Alternatives, reporting to you from the CME Group in Chicago with the January SFG Futures Strategy Fund commentary. Well, January started off with a different texture, a different tone, a different feel to it. It is true that managed futures on the whole did very well in January, but it had a different feel in that it seems like there's a breakdown in correlation. The quantitative easing that we're seeing perhaps isn't having the same effect on the market, and we're seeing correlations from markets starting to act on fundamentals and convention as opposed to anything else. Also, what's striking is that managed futures tended to do very well in January, even though volatility was low. As we've said in the past, managed futures tend to do much better in higher vol environments. Well, volatility in most asset classes still remain very low. However, managed futures still did pretty well. Let me break it down real quick for you, help you to see where these returns came from. And again, this is in general. First of all, the equity markets. The worldwide equity markets rallied in the beginning of January. So with that one direction move, that was very good for trend followers and global macro traders. It wasn't good for counter trend or mean reversion traders because they're looking for the correction and never got one. So all in all, very good for trend following. Moving on to rates. Now, rates was a very different story. We saw the U.S. Treasuries rally 20 basis points in the month of January. That's something we haven't seen in a long while. A lot of long-term trend followers have been long bonds for a very long time. That was a very difficult environment for the long trend followers. It was, though, good for like diversified strategies and some short-term trend followers, but that was a big game changer. Moving on to FX. Well, FX was very good for trend followers of different durations because the theme stayed in place. We had a short yen environment. The yen went to a 30-month low against the US dollar. Also, we saw the euro currency rally 3% against the greenback. So that was a good environment for diversified strategies, currency specialists, and trend followers of different durations. However, it was not a good environment for mean reversion and counter trend, similar to the equity markets. Lastly, commodities. Now, this is a mixed bag because we had a pretty good rally in energy and metals, and also a big retracement in the ag market. So it was a mixed bag and really hard to say, but in aggregate, we can say that commodity specialists did very well, and trend following was mixed because in all the commodity space, there were so many different knee-jerk moves. So at the end of the day, it was really exciting to see managed futures get off to a good start in January of 2013, and obviously we all hope it continues. But what's more important is to look at managed futures as a intentional asset allocation for your portfolio, because you just never know when managed futures will do well for you, because if you look at history and history alone, you'll see that managed futures have tended to be non-correlated in rising markets and negatively correlated in down markets. But again, I cannot predict the future. I don't want to. I just would love you to get managed futures exposure somehow and some way. I'm Larry Schober, CIO of SFG Alternatives, reporting to you from the CME Group in Chicago.